Well, for more on the inflation numbers, we're joined now by Shannon Grein. Shannon Grein is an economist at Wells Fargo, and she joins us now. Shannon, thanks a lot for joining us. So again, U.S. inflation numbers on an annual headline basis come in at growth of 2.9% in the consumer price index. That is what economists had expected in the aggregate. That does represent a pickup of 20 basis points from November's pace of annual headline inflation. On core inflation, the numbers are slightly more modest than expected. 3.2% was the pace of annual core inflation. That is 10 basis points less than economists expected, also 10 basis points less than the November read. What are some of your takeaways here, Shannon?
Yeah, so I think this report pretty much, came in as expected, as you said here, right? We matched consensus. You had a little bit of an upward surprise on the headline with that year-over-year ticking higher, but the fact that core remains steady on a year-over-year basis does suggest kind of what we all were looking for, right? Kind of the stalling and the progress on inflation. So I don't think this really changes anything for where the Fed sits at this point. I think the Fed's going to take a cautious approach to further reduction in rates, and depending on how the data evolve in January and February before their March meeting, we'll see kind of what the expectation is in terms of further easing.
Shannon, as Canadians, we're all glued to any sort of news around tariffs coming, and we're concerned about that. The flip side of tariffs, as you know, is that it can be quite inflationary. How are you guys looking at that at the bank in terms of the negative repercussions of tariffs for the U.S.?
Yeah, so I think tariffs are the biggest headwind in the near term to further inflation progress in terms of the U.S., right? So obviously you've seen some of that deflationary impulse on the core goods side kind of run its course. So we're not going to get as much of a pull down from the goods side of inflation going forward. But the tariffs add, I think, a wrinkle to this in terms of further progress. So I think that's part of the reason you have the Fed maybe taking a more cautious approach headed into this year, right? Kind of waiting to see which tariff policies are actually passed or come to be passed once the Trump administration takes over in terms of office. But we are baking some tariffs into our forecast at this point. Obviously, we'll get a little bit more clarity and adjust the forecast accordingly, but tariffs are inflationary at face value. Obviously, businesses can absorb some of these costs, but to the extent that they are passed on to the consumer, I just think it makes the job of getting back to 2% a bit harder for the Fed.
And what about government spending as an inflation risk as well? As we've already noted on this program, Jamie Dimon, the chief executive officer of JP Morgan Chase, flags, quote, ongoing and future spending requirements as likely inflationary. How are you thinking about government spending at Wells Fargo?
Yes, I mean, I think you've seen the market start to pay a little bit more close attention to this more recently with just the upward move in longer term yields generally, right? That's pricing in the expectations that the Fed's going to ease at a bit of a slower pace than we all expected previously. And then I think they're also paying attention to just this large deficit situation that we're facing in the United States from a fiscal spending perspective. And then when you put the lens on of the Trump administration coming in and potentially, extending or even expanding tax cuts come 2026, I do think that could be inflationary. So I think we're obviously paying attention to it in terms of our forecasting, and I think the market has also started to pay attention to that, and you see that again in terms of longer term yields.
So where does the Fed's battle against inflation now stand?
So I think the Fed is looking at inflation in terms of they're still targeting that 2% that they've had as their target for a while, and they're getting, inflation remains a bit stubborn above 2. So I think you have the Fed that's going to continue to ease this year, but at a slower pace. So we still look for further Fed easing, but again, probably a bit cautious in the first half of the year as they try to see what's going to come from the Trump administration in terms of the fiscal initiatives before they react, just based on stated objectives at this point.
Shannon, what's the black swan or low probability, but we really hope it doesn't happen, sort of scenarios that you folks are thinking of? Is there a world where, for example, there's actually a rate increase in the U.S.?
So that's not our base case at this point, that we're looking for any type of increase in terms of the Fed funds rate this year. We're still looking for further easing. We have a little bit more easing than the market does currently in our forecast. Now, when we get to 2026, I mean, that's something that could be on the table, right? Particularly if you do get tax policy and you do get inflation that's not only stalling or stubborn at these rates like we saw in today's data in terms of the annual pace, but if you actually see a reacceleration in inflation, that's when I think you'd actually see a Fed that starts to actually think about hiking rates. So not the base case at this point. Tariffs, again, are the near-term headwind, and then further on, I think it's just more so some of those structural changes that are keeping inflation a bit higher, and then again, potentially fiscal policy initiatives that might boost inflation longer out.
And what is your base case call on rate cuts by the Fed in 2025? 2?
So our base case is still for 3. We are in the process of updating our forecast as well, and I do think there's a bit of a downside to our forecast. So we still have, again, 75 basis points in that forecast. I think there's a little bit of a downside risk to that. I think today's data, again, kind of came in as expected, came in with a conclusion that inflation has stalled, but it's not reaccelerating. To the extent that we see continued progress on inflation in the next few months, without that reacceleration, I do think the Fed could ease policy, particularly as the restrictive stance of policy is impacting certain parts of the economy, even if overall economic growth in the U.S. remains pretty strong. So we still have some Fed easing in the forecast, but I do think they're going to be a bit cautious in this first half of the year. Again, kind of in a wait-and-see mode. Let's see what happens with tariff policy. Let's see how much actually comes to pass, when those tariffs will hit, and just how big of an inflationary impulse they actually will have.
Shannon, thank you so much for your insight this morning, helping us understand these brand new U.S. inflation numbers. Shannon Grein, an economist at Wells Fargo.